What's up, ASOS fans? Mike here. I just want to congratulate anybody who bought ASOS down at £5, 10, like the $6 area. I think that is an extremely good deal, and I think you're probably up like a third by now, depending on when you watch this. But that is that was quite a cheap price. So anybody who took advantage of that, I want to congratulate you. And just quickly before we get going on ASOS, I want to say this is my disclaimer. If you are investing based on YouTube videos, you are nuts. Don't do that. That is a good way to lose all your money. So do your own research and do a lot of it before you buy any stock. This is just me talking about stocks I own. I'm just a guy. I'm nothing special. I have an investment system that works for me. And so, yeah, don't follow what I do. But if you get any information from this, as it's helpful, then that's sort of my goal here. I do these videos just for fun. I enjoy doing these videos, and it helps me be a better investor, having to explain what I think to a camera, knowing that other people are going to watch. But yeah, I got no angle. I'm not selling anything. This is just for fun. So let's talk about ASOS 2022. Results are in. They're where we expected them to be. Sales were up 4% to almost $4 billion. Profit before tax was basically break even. The margin was 0.6% and $22 million pre-tax profit, and that's down from a 5% margin the previous year. We all know why this has happened. The supply chains, input costs are up, which means gross margin was down by almost 2%. ASOS is a cyclical business, and we're going into the down part of the cycle here. That's just the truth of what's happening, and the stock is reacting as cyclical businesses do. When the bad part of the cycle comes, everyone sells and runs away and acts like the change is permanent. If your time frame is a year or less, it's probably going to make sense to sell. Because I don't know if this is going to turn around anytime soon. But my basic idea here is that ASOS is not dead. They're just going through a normal cycle. And then when the tailwinds pick up, the economy picks up, then we'll get back to a good part of the cycle again. So that being said, quick notes on the financials this year. I talked about profit before tax. I talked about sales. Those were kind of expected. It's a bad year. Premier customers was up 12%. I think this is a good sign. I watched this one. This is one of the important metrics because it shows engagement. It shows whether people are connecting more with the platform and using it more. And they have, the people who are on Premier, the Premier program have, a very high level of recurring orders. So that's a good sign. One of the other big ones that I watch is the US sales. And this is a little bit more problematic, I think. The total sales for the year are up 14%. But if you dig down, the active customers are actually down 1%. And that's possibly why Jose, the new CEO, he's talking about, he's saying their international strategy is not really working as planned. That's one of the things he's going to work on improving. But yeah, U.S. performance concerning. Now, I don't know if they've had a chance to fully ramp up yet. They're still building their partnership with Nordstrom, and that's still in the works. But at this point in the cycle, I would expect that their growth rate is higher than this. So that is concerning. I might not talk about anything else from the financials unless something jumps out at me here. I don't think so. So basically what I want to talk about today is I'll go over my thesis again, which is splitting into two views here. One is more of a short, medium term, and then there's a longer term one. But and then I'll talk about my views on Jose, the new CEO, and the strategy he's starting to develop for the company, and what I think that means for maybe medium term. Okay, so if I look at my my thesis, I touched on it quickly there. It's basically the idea that this is a cyclical business, and the margins go up and down. If you look at a 10-year chart, you will see in the chart what's happened to margins. That chart is a reflection of how the margins have gone. When they go up to 4 or 5%, the stock moves up very quickly because margins are expanding really quickly in a percentage term. And then the opposite happens on the way down. So just as an example, if you go from 1% margin to 4% margin, you've quadrupled your profits. And so the market does what it always does, is it extrapolates this stuff into infinity and goes, whoa, the margins are increasing super fast. If that keeps going, they'll be at 20% margins in 3 years and they'll make $1 billion. And so I think that's crazy. I also think what's happening right now is crazy. The margins are almost zero, and people are saying, well, if this contraction continues, they'll be losing money like crazy next year, and basically they're going to go out of business. So my whole bet is that they're not going out of business. They have a huge amount of liquidity. They have, I think, over 600 million in liquidity in terms of cash and revolving line of credit they have. And even if they had a bad year where they lost a bunch of money in 2023, which is definitely possible, if this recession really gets moving, they could lose a pile of money. But I don't think that that's enough to really put a dent in the company and endanger it, just based on the liquidity level. Their current, they have one outstanding loan, which is a convertible loan, and the interest rate on that is 0.75%, and that's due in 2026. So I don't think there's the debt risk is almost non-existent. And so basically just the worst case scenario would be a huge negative cash flow year. Let's say they declined by 20% in sales. The operating leverage would end up magnifying that problem, and that would be a negative scenario. Now, I'm betting that's not going to happen. I think that really what I'm doing is I'm saying there's a good year coming. It's in 3 or 4 years. Within 3 or 4 years, there's going to be one good year. We're going to get out of the economic problem. The margins will go back up to 3, 4, 5, maybe even 6%, based on some of the stuff I'll talk about in a minute here. And then the market will react like it always does. So that's the medium term. That's the one-off revaluation sort of thesis that I'm working off. Now, I have a longer term view that's developing here as I study the competition a bit more. So if you have companies like H&M or Zara, Zalando to some extent, they're probably more similar to ASOS. But these big fashion companies, these are basically entrenched companies that have brands that are that have stood the test of time, and they're entrenched in the world. These are global retailers, and I don't think they're going anywhere. And if ASOS can get to the next level, and they talk about it becoming a truly global retailer, I think that's the statement they say, then you have a longer term business that has potential to get up to 15 billion, maybe even 20 billion on the upside in terms of sales. So that's the longer term thesis. I'm going to hold this for a few years, and I'm going to see if they get there. But one of the big things that needs to happen there is they really need to become established in the US, and I don't think that's happened yet. I think this is a UK business with operations in Europe and the US, but they're not really. They're primarily a UK business right now. So they've got to get over that hump and get out of the UK and become established in the US particularly. So those are my two theses. I don't actually know the plural. Theses? Help me out, guys. All right, I'll talk about Jose in a second here. Okay, so about Jose, who I was listening to for the first time here on the earnings call, I thought he sounded quite good. I thought that he was saying all the stuff that I would want him to say. But I don't know if I believe yet that this is going to work out. So he's a new guy in the role, obviously, and I think he's set the bar pretty high for himself, actually. so my impression of what happened here is he's come out and said, it kind of threw the last the last CEO under the bus, saying, well, there's a bunch of stuff that's broken that we're going to clean up, and then we're basically looking to become cash flow positive in the second half of 2023, which I think is a very ambitious target. If I was him, I probably would have given myself at least another half to right the ship. Also, with potential big economic downturn on the way, I think he set the bar pretty high for himself. So I'm not actually expecting cash flow positive in the second half. I'm going to expect it in 2024 as my goal. If it comes earlier, then that's great. But I think he should have given himself a little bit more rope, because this is the chance that he had to do that. Anyway, I like the confidence. I like that, he seems to have areas where he thinks he can squeeze some margins out of, and particularly, so there's laid out this 4-point plan. So renewed commercial model, stronger order economics and lighter cost profile, robust and flexible balance sheet, refreshed leadership, team and culture. Now, a lot of this just comes down to stock management. I mean, that's their biggest. It's the biggest line item. It's their biggest balance sheet item. And so what he's saying is basically they need to. Well, actually, he used a good analogy. I liked his analogy about. He said we're selling fresh fish, right? If it doesn't get to market fast enough, it starts to stink, right? And so he's saying that they've had to write off a lot of stock and discount a lot of stock because the stock management hasn't been optimal here. So he's going to try and tighten up the time between, ordering the stock and getting it to the customer. They're going to work to improve their warehouse systems, to cut costs there a little bit and get the orders out quicker. And so that's a big part of it. I think he's writing off. I forget the amount. They're writing off a big chunk of the inventory from last year where they were overstocked and had all the mess from the COVID stuff. So I think that if I'm reading it right, it looks like there's a few percent potential gross margin there that they can, gross margin and operating margin that they can squeeze out of there. And so keep in mind, if you're going from 0%, you don't need to squeeze a huge amount of profit to make the company look really good, right? To show a good result. So if we can just get 1-2% here in the stock management, 1-2% on the sort of the employee overheads, then it looks like I'm feeling pretty confident that we can get back to a 4 or 5% level. So now there's other stuff going on here. If I read between the lines, with the refreshed leadership and team culture, it sounds to me like there's probably layoffs coming. He's saying they're going to simplify their management structure, which sounds like layoffs, and they're going to sort of squash the hierarchy and remove some layers. That might be wrong, but that's what I'm guessing. And I think that's probably what they need. They just need to simplify their operation a little bit. He also talked about, what else? He wants the working capital down. The CapEx number is actually coming down this year. So now I don't know if that's going to have an impact long-term. They're actually going to hurt their long-term growth prospects. But I think that he's showing to me that the company looks like it's going to be more interested in shorter term results, as opposed to the previous management, which was more about big picture growth, right? So they were investing heavily in CapEx and automation and these sort of long-term projects to build out their infrastructure. And Jose sounds to me like he's saying, let's make some money now, right? As well as grow, right? So I think that's actually potentially a good path. Now he is new, and I don't have much to go on whether how much I believe this strategy or not. So I'm just going to have to wait and see. What else do I want to talk about here? I think that's pretty much it. Oh, actually, I want to talk about a longer term idea here with this company. So if we're talking about an economic downturn here, and the company is sort of tightening up operations, that's the general theme. They're tightening up the ship so that they can squeeze out some cash flows in these hard times. Now, when I'm sorry, I don't have a better example, but off the top of my head, and what I've been thinking about is in 2011, the price of gold was very high. I think it was almost up to $2,000. And all these gold mining companies basically got fat, right? They had these huge cash flows from the cost of their operations. They pushed CapEx up through the roof. They hired people like crazy, and it was a party time, right? Because they had so much cash, and they still made tons of money, even though they were blowing all this money. And then what happened is the downturn came, the gold price went down, and a lot of companies were underwater, right? Because they'd become inefficient, and they just kind of expected that this boom time was going to go on forever. So then after that, the ones that survived had to right the ship so that they could survive in the difficult times. And then when the price went up again of gold, they were making massive cash flows, and they had learned their lesson, and they weren't going to do that again in terms like start partying like it's 1999 again. So I think that that's possibly what's happening here with a lot of these online businesses, not just in fashion, but a lot of these companies, the capital was really easily available the last few years. You had record high stock prices, you had huge liquidity in debt markets, and companies didn't really need to be too prudent with their expenses, right? So you're seeing this major problems in a lot of these unprofitable tech companies, and ASOS is not unprofitable, but they're in that world of they were benefiting in that environment. So I think if we look maybe 3 years out, all this cost cutting and these efficiency gains could create a great foundation for and actually a higher profitability profile when the economic situation turns positive again. And I'm a believer in cycles. I don't think stuff stays the way it is forever. And regardless of how bad this gets over the next year or two, it's going to be good again at some point. People buy clothes. People like buying clothes. Economic prosperity always returns. The governments always support that stuff. If stuff gets bad, they'll inject liquidity if they need to. And so there's a good year coming. And I think that my hope is that these improvements will create a situation where the ASOS can even get a higher rate or a higher profitability than they have in the past, right? So maybe exceeding their 5% pre-tax margin they had before. So one last thing I thought was interesting, I was looking at a lot of deals in the fashion industry where companies were being acquired by other companies. And it looks to me like it's very rare for a company to sell for less than 1x sales. And I found one company that sold at 0.8 times sales. That company was not doing well. I forget what the name of them was, but that was the lowest valuation I saw in terms of a deal. Even Reebok, who we all know, brand name, but they never make money apparently. They haven't made money for a long time. They sold for over 1x sales. So I'm just thinking in a worst case scenario, let's say stuff starts to go wrong with ASOS. Sales start declining, we get a couple of percent decline year over year, and they end up in a negative cash flow situation and there's no way out. I would say that there's other companies who'd be interested in acquiring their brand names that they have. They have Topshop now. They have their own in-house brand names, and ASOS does have a brand name. It's, regardless of what you think of it, it's worth something. They also have automated distribution centers, which will be complete. They'll all be completed by the end of next year, and and they have 25 million customers and 4 billion in sales, right? So I think it's highly unlikely that in a negative scenario where they had to sell the entire business to a competitor, that they would get less than 0.5 times sales, which would be $2 billion. And then you subtract the debt from that, of course, and that would put the stock price in the range of $16, $17 on the U.S. market there. So I think there is a margin of safety here. I don't think that this is a potential for a zero. I think that there's value here, and that's just basically that's the margin of safety I'm looking at. Now, it doesn't protect us in the scenario of just a slow, painful, long-term decline of the company where they don't sell out. I mean, the stock price could just remain down, you know, in the dumps permanently if they're just in a perpetual decline, right? So that is a risk if things started going wrong. But I do think that if you're looking at actual asset value and value to a competitor, it's probably quite a lot higher than the current market cap is. Other than that, I guess my summary is that I like what I heard from Jose. I thought he was saying the right things. His plan seems to be in a direction that I'd like them to go in. I'd like them to start being a bit more efficient with their expense profile and their capex, and start squeezing a few percent margin out of here and there, and try to weather this economic downturn without going cash flow negative. Because I think if they do that, then the upside's pretty big when we get back to the back into the good economic times. Yeah. Other than that, I'm happy to keep owning this. I'm up over 10% in my position now. My average price is about $12.50 or so. So I'm still underwater. I still think $12.50 is a good deal. Obviously disappointed that I didn't just wait and buy it lower, but I'm still happy with that price. I still think it's a very good deal, especially if we look at a price to sales basis, that's about a 0.2 times sales, or 0.25 times sales. Yeah, I think that's it for now. Hope you guys got something from that. And I think that's it. Have a great day, guys. We'll see you in the next video.